Hello, everyone. Good afternoon, public community. We are back with another great public live session today. We're going to be talking about what's happening in the broader ride-sharing market. And here, of course, to break things down for us, we have Mark Mahaney, who is the Senior Managing Director and Head of the Internet Research Team at Evercore ISI. Mark, welcome back to Public.
Hey, good to be back, Corey.
I'm glad to have you here. Now, I'm going to start by just a personal anecdote because I do live in New York City, and I am someone who feels like I've been very upset that Uber Pool disappeared, but I do understand it was not a revenue generating division for Uber in general. So that is a company that I want to start with today, Uber, and what is going on with the rideshare growth trends.
Well, they still haven't fully recovered. This is an industry, ride sharing, that's still, in parts of the world, it's fully recovered, but not in North America. It's still 30% below, 20 to 30% below where we were pre-COVID. And that's because there's still some use cases that are down materially. Business rides to airports and commutes. Social usage of, the top reasons that those are two of the top reasons that people use ride sharing. The third one is rides for social events, to theater, dinner, parties, get together with friends, et cetera, on the evenings. And that's pretty much caught up. But there are these other use cases that haven't fully recovered. And in some ways, it's kind of a negative derivative of the work from home reality that many, at least white collar workers, are living with post COVID. So anyway, that's what's happening with ride sharing. We are seeing a recovery. It is happening, but we're not fully back at 100% yet. We think that does happen, later this year, and we continue to look at these assets, Uber and Lyft as the two best ways to play this. There are some international ways to play this, but in the U.S. market, these are two stocks that have been materially undercut year to date. Let's see here. Uber's off 48% year to date. Lyft's off 64% year to date. So they fall into what I call sometimes spec tech or speculative tech. So these are tech franchises that are not yet profitable or not yet meaningfully profitable. That means there's no valuation support. And when the market gets fixated on value, as it certainly has since last, call it November, then there's very little appetite for these kind of assets. But that at some point will change. And when it does, and you put together what I call a beta basket of tech stocks, I think both Uber and Lyft should be in that beta basket.
Mark, I'd love for you to just give us a holistic view of what is happening with these ride-sharing companies pre-pandemic to post-pandemic. And I know you just gave us where these growth trends are going, but pre-pandemic, were there really a lot of growth opportunities for the likes of a Lyft or an Uber? I'm talking like 2019. Was that something that you, as a top tech analyst, would have said, hey, yeah, this is, the companies that you want to invest in? And then you think of everything that happened over the past 2 years. You gave those great statistics a moment ago about, how off the stock has been. But is it possible that perhaps they've already reached their max growth potential in this market?
It's possible, Corey. It could be that they've hit their Netflix moment. That's referring to Netflix going X growth at the beginning of this year, and probably not peaking out, but that's certainly that's certainly a reasonable expectation. But it's probably not the right one. But anyway, it's possible that Uber and Lyft have reached their market maturation moment too. I don't think so. And one of the reasons I don't think so is we run these annual surveys. So, get a couple of thousand people together of your closest friends or survey respondents and ask them about their ride sharing usage. And what we found is that about 42% of respondents in the U.S. have used ride sharing. Now that's up from pre-COVID, that's up from about 37%. So it's risen. Maybe that's not a huge amount, but it has risen. But then if you look at urban millennials, their usage is now at 60%. So 60% of them have used ride sharing. So I think about that. That's, to me, is kind of the bogey. I don't mean to imply that urban millennials are everything, but they usually are a decent lead indicator of where overall markets can go. And by the way, I assume their 60% continues to rise. So I think there's still more room for growth in terms of penetration, in terms of the percentage of people who will use ride sharing. The second thing is So I track penetration, but also frequency of usage. And there we find that the number of people who use ride sharing on a regular basis, like on at least a weekly basis, daily or weekly basis, that's now at about 28%. That was at 13% prior to COVID. And I think, again, I watch those urban millennials. I think this percentage can get up to 50%. So I think both penetration and frequency can rise. So I still think there's a lot of running room for ride sharing. And I'm going to keep it real simple. It comes down to the value prop. How good is the value prop? Why do people like ride sharing? And when we've surveyed people over the years, we find there's 4 reasons why people like ride sharing. And the answers are pretty even across all 4 of these features. First, people find it more convenient than taxis. Secondly, they find it more convenient than public transportation, or more reliable than taxis, more reliable than public transportation. They find that it saves them time, and they find that it saves them money. All 4 of those features are pretty consistently called out by people who, when you ask why they like ride sharing. So in my mind, it's a pretty broad value proposition. It's just, Corey, in New York, you're probably used to, although prices have been rising, you probably become used to over the last 5 years to using ride sharing in a way that you never would have prior to the rise of some of these services. So I think that there are global markets, and I think you're going to find something like this that'll just change the way consumers, get around. And it's, you're talking about changing consumer behavior. That always takes a long time, but it does happen. And one of the reasons I like Uber as a stock is that I think it's a massive TAM, total addressable market. Like, I think we're talking about $1 trillion in spend when it comes to transportation, all in. And this is a business with very heavy network effects. Whoever's got the most, drivers in New York City, well, they're going to attract the most riders, because riders want, liquidity, or they want fast service. And so it just kind of feeds on itself. They're really strong local network effects. And then if you can find the company that's the global leader in ride sharing across pretty much every market, that's an asset that's probably going to be worth a lot more several years from now than it is today. It's also, and I'll stop in a second, it's also, they have this complementary deliveries business. And so, Uber Eats, but now that's expanded through the ownership of Drizzly. And other things into the delivery, not just of restaurant takeout, but also grocery, and also convenience, and also pet supplies, and also alcohol. So there's just they're creating this transportation network of moving people and things, and I think something like that is just worth massively more than it is today. They're on a free cash flow inflection point this year. They'll finally start generating free cash flow, and as those levels start to pile up and compound, the stock will compound too.
Yes. You know what, Mark? I actually like that you brought up Uber's complementary business, which is clearly Uber Eats, which has always made me think, why don't Lyft and DoorDash get together? It's easier to buy somebody else's company that's already up and running to help you better compete in your market in terms of Lyft and Uber competing. I don't know if that's possible. I don't know anything about that M&A space, but it seems like it could be a good idea. But I want to bring it back to our current conversation, specifically around ride sharing. We all know first day of summer, that kicked off yesterday across the country. We talk about the summer travel season, and you can't talk about the summer travel season without talking about gas prices. But this is something that has been impacting ride sharing companies as well, not just everyday people who might be driving their cars. And there's that economic uncertainty, Mark, and what I call the dreaded R word, which is that potential of recession. I'd love to get your thoughts on the impact that this could have on everyday people like myself who use ride-sharing services over the next few months. Take me through the summer.
Well, let me do 2 things. First is, gas prices have clearly surged over the last 2 months. Uber and Lyft have both implemented fuel surcharges, and I think it's between 40 and 50 cents per ride. It's a fee that's paid directly by the rider, the consumer, to the driver. It may not sound like a lot per ride, but the average ride we're talking about is like a couple of miles. It's not, the average ride is usually not the ride from downtown Manhattan out to JFK. The average ride is usually a couple of miles, a couple of minutes. So it does add up to for drivers. It's possible that Uber and Lyft are going to have to increase that even more. And that the rising gas prices, that has been a bit of a supply constraint. Their drivers, you're going to make a little less money if the gas prices are spiking like that, it's a little less profitable. You could generate 40 to 50 bucks in revenue driving, which is a lot of money per hour in LA, but your fuel costs are going to eat up more and more of that until gas prices start stabilizing. So yes, it is an issue, and it does impact the supply side of the dynamic. And then Corey, you raised the issue that everybody should be focused on, which is recession, and which companies, as the possibility rises into a probability greater than 50% chance that we enter into recession. Maybe it's a mild one. That which companies are more recession resistant and which are more recession exposed. Then I look at ride sharing and delivery. I think ride sharing is a little bit more resistant. There's also these odd little dynamics, which is unfortunately, if in a recession and job loss environment, a quick way to get to do a side hustle to make that couple of extra $100 a week is to do delivery or ride, being a driver for ride sharing or delivery. So that'll help unlock a little bit of the supply problem for Uber and for Lyft. But yes, at the end of the day, we are all if we're gonna be tightening up our belts in the wake of recessions, in the wake of a recession, in the wake of high inflation costs, we're probably going to cut back a little bit on our social trips, a little bit back on our vacations. Maybe not this summer, but the following summer, probably. And so there's going to be a pro and con on this when it comes to ride sharing. Good for supply, bad for demand. The businesses are just going to have to work through that.
Yeah, it's going to be a rough summer all around at this point. And you did touch a little bit on inflation as it relates to the broader economy, which is, of course, plays into a big part of the economic uncertainty. And those rising gas prices, lots of pain. I imagine for Uber and Lyft drivers, this is the same sort of thing. But specifically, the driver shortage issue, which both companies have been talking about since the pandemic started. This has been a major problem for them. How much did that play into, the pain that riders are going to feel?
Well, I think it plays in there, and to the extent that Uber and Lyft have had to offer more driver incentives and subsidies to get drivers back out. Now, you mentioned something at the very start of this, which was Uber Pool, and Lyft has got shared rides. They've started bringing those back. Now, remember, part of that's COVID. The first thing that was shut down was by CDC, or one of the things that was shut down or reduced was shared rides. And that's Lyft has only been offering that again in major cities over the last couple of months. So that'll be that's a cheaper way for each of us to do. It's usually used, for social occasions and for commutes, work commutes. So that'll be a cheaper way for us to get around. So that'll be a kind of a boost to demand. So there are all these puts and takes. I do think that you want to stay focused on the secular growth opportunities, realizing that the recession is going to negatively impact demand, but there will be puts and takes on there. Shared rides and things like Uber Pool is part of that. In terms of just the companies itself, I continue to look at Uber as a stock that I think where the multiple could go up materially, especially as they start finally emerging into profitability land and start generating material amounts of free cash flow starting next year. I think that those shares are worth above $70. So I think there's a lot of upside in the stock from here. And I realize that shows a lot of upside. But look, we've had a dramatic sell-off in tech stocks. So, what can derate dramatically, what can trade off dramatically, can also trade up dramatically. And Lyft, for us, we also see a material amount of upside. We have something like a $40 plus price target on that name as well. And I just want to step back, when I think about, I want to find companies with really large market opportunities that usually are founder-led. That's the case with Lyft. That's not the case with Uber, however. But that founder probably needed to step down from that company. And then
I like the way you said that, Mark. That was very PC.
And then there are pros and cons to what happened there, but I don't. The one thing I think that sometimes gets lost in all the shuffle, and I'm a huge fan of the Uber book that was made into the TV series. And the name escapes me now, but I did read it avidly, which is Super Pumped. That's the name of the book and the series. But that Uber and ride sharing as a whole was trying to grow up in a time when there were massive obstacles facing both of those companies, from local taxis commissions and local public officials. And so they had to get very aggressive, and even just to break through and allow consumers the chance to at least try ride sharing. I just want to throw that context out. Anyway, I still think with Uber and Lyft, based on our survey work, I think the value propositions are really strong, and I think these companies have very strong competitive positions. Like if you were to name, list for me all of the new ride-sharing companies that have emerged in the market in the last 5 years. The point of my question is there haven't been any. I know there's some small players here and there, but there really haven't been any. There haven't been any sizable companies because this is it's an easy business to start, but it's very, very hard to scale because any driver that you try to bring on your platform is going to say, well, how many riders you got? And any rider that you want to bring on the platform is going to say, well, how many drivers do you got? I.e., it's a network effects business. And so that's just a matter of scale and driving the businesses towards profitability and part of Uber and Lyft. And I think you've got a very early stage opportunity at both of these names.
With both of those names in mind, and you've mentioned your survey, I just wanted to tell everyone this is actually the 5th annual U.S. ride-sharing survey that you all have put out. Is there a clear winner right now in the market between Uber and Lyft when it comes to ride-sharing, and why?
Yeah, there has to be. And I think the answer is Uber. So the market share numbers shake out like this, Corey. Uber accounts for about 70% of ride-sharing activity in the U.S., measured in terms of total revenue generated. And you would have Lyft at around 25%. Now, geographically, it's a little different. In the West Coast, Lyft has stronger market share. One of the reasons why Lyft has underperformed Uber is that the West Coast, where I am, frankly, has just been slower to recover for a variety of different reasons. But it's been slower to recover in terms of mobility. To where I work in downtown San Francisco, it can still look a little bit like a ghost town during the middle of the week. I don't think you can say that about Manhattan. Anyway, that sort of hurt Lyft a little bit, but I just lost my train of thought on this, Corey. But
it's quite all right.
The big point is Uber is the dominant market share player in North America, but just also remember this is a global company. There's about 50% of Uber's rides volume is outside of North America. The one ding, and it's a major ding on Lyft, is that it's just a North American only company. And I generally find as a stock picker, you want companies that have got global exposure, assuming they're not losing all of their money in international markets. And I think Uber has shown the ability to scale up internationally and scale up profitably.
Well, I'm just happy that Uber has finally brought back their new version of Uber Pool so I can try to save a little bit of money somehow this summer. Mark, one last question for you. We're going to transition away from ride-sharing companies and talk a little bit about streaming very quickly. Spotify, trading around $100 a share. That's down from a 52-week high of $300. It almost pains me to even say that. The company's Investor Day earlier this month. What were some of your key takeaways from that Investor Day, and how are you feeling about the company heading into this back half of 2022?
So look, I've had a buy on Spotify since its direct listing 4 years ago, and the stock has done nothing. In fact, it's actually traded off, and it recently hit an all-time low recently. So it tells you that I know very little about the stock, or I had a terrible call on it. But, I always try to think about next play. What do you want to do with the stock from here? We can talk about the past, but we're trying to make money going forwards. And so I think about Spotify. Look, it's still the global music streaming leader. Find a big market and find the company that's leading that market. And, music streaming, I think, is all, and it's not just, it's audio streaming, because they're also rolling in podcasts and my favorite audiobooks, which is pretty small, but they are rolling it all in. They're the global leader. And what I find so interesting is that they're the global leader on Android devices and on Apple devices, even on Apple devices where Apple Music has got kind of home court advantage, where it's kind of hard not to get pitched. Apple Music is a subscription service if you're just an average iPhone user. Spotify does have more share than Apple does. It's got more users. So they clearly have been doing something right. And what they've been doing right is product development. It's a very clean, intuitive experience, and they're rolling out more and more content for you in the form of podcasting. They got years ahead of other people in realizing the importance of that market. What Spotify needs as a company, and it needs as a stock, is it needs to prove the business model. They need to prove that they can expand their gross margins. And really quickly, Corey, this company's revenue has doubled over the last 4 years, but the gross margin hasn't changed at all. Tech investors, look at that and they say, well, there's something wrong here. I mean, your revenue doubled, but you can't scale that. Like, where's the scale? Scales usually it usually translates into gross margins expanding. That's not happening. But why that isn't happening is the real key thing. And what Spotify recently disclosed is that their core music gross margins actually have expanded from 25 to 28%. They never disclosed that. What's kept those gross margins under pressure is all of this investment in podcasting. So you have to ask yourself as an investor, do you think there's a there with podcasting? And do you think it can scale up to profitability? And I think the answers to both of those questions are yes. I think we'll start seeing gross margin expansion, across the company as a whole next year. If I'm right on that, that's the unlock on the stock. So I continue to like Spotify, but fully cognizant of the fact that the stock has done nothing in 4 years, and in fact is dramatically underperformed and is at all-time lows. But the streaming market is still there. This is still the leader in that market, founder-led company, great compelling value proposition. Of the 295 listeners, my guess is that probably 200 of you are customers of Spotify. I don't know how to prove that, but I just throw that out anyway. So that's why I like Spotify, and I think as this company sort of scales materially to profitability, again, it falls into this speculative tech high beta basket, and we're not buying high beta now. But once growth equities come back, I think the stock has a lot of opportunity to outperform.
Well, Mark, I love your optimism. And hey, you're a top Wall Street analyst. And if you think that Spotify is a vibe, perhaps the rest of us should as well. And thank you for joining our session.
Thank you, Corey.
Mark.
Thank you, Corey. Always good talking with you.
Yes, always great. Everyone, once again, this is Mark Mahaney. He is the Senior Managing Director and Head of the Internet Research Team at Evercore ISI. And something I forgot to mention to everyone off the top, he is also the author of a new book titled Nothing But Net, 10 Timeless Stock Picking Lessons from one of Wall Street's top tech analysts. And we are going to be doing a book giveaway, everyone, for 5 listeners who tuned in today. See, I know you guys got those emojis going. You're loving that. I see you guys. Thank you so much for joining, and we'll see you all next time.
See you, Corey.
If you would like to see more content like this, subscribe to our channel and download the public app where you can listen to these sessions in live time.